Many analysts have cut their growth forecast for India below 6%, expecting a deficient rainy season to hit agricultural output. As the country ushers in a new finance minister, it continues to face a host of problems, including slowing investments, high inflation and a weak currency. So, what do businesses expect from the government that has often been criticized for not moving fast on key reforms? I sat down with Aditya Puri, Managing Director of HDFC Bank that recently became India's top valued lender, and began by asking him what steps the government should take to boost the slowing economy.
Growth to some extent has been constrained by the fiscal deficit. More than just a constraint of the fiscal deficit, which should be brought down, is the cause of the deficit, which is the high subsidies, which are non-merit subsidies, which are also not reaching the intended beneficiaries. We also need to improve our tax collection, which is the GST and DTC. However, we do need substantial improvement in our investment climate.
You mentioned investments slowing down. How has that impacted the banking sector? Have the number of people and businesses taking loans gone down?
Yes, but not to the extent of the alarm that everybody talks about, as if we're going to hell in a handbasket. No, the fact of the matter is that the slowdown in the GDP has been gradual. It's not that 8.5% is slumped with a crisis like we have in the West to 6%. This has been a gradual slowdown. And banking system growth has slowed down from the 20 plus to below 20, somewhere between the 17 to 20%. So what I'm saying is there is a slowdown. Has it had an impact on the banking system? Absolutely. Is it a slowdown that can be managed and should not be the cause of alarm? Yes.
Speaking of raising alarms, almost all of the ratings agencies have said that India's credit rating is in threat of being downgraded if the policy paralysis is not dealt with. Do you agree with that?
No. Now let me say two things. Firstly, let's look at the credit default swap rate, which is a reflection of your likelihood to default. So if you look at India's credit default swap as a proxy, you can take Exim or State Bank, it's 350 basis points. We are rated BBB minus. You know the credit default swap on Italy? It's approximately 550. On Spain, it's closer to 600. And they are rated BBB plus. And I do believe that the spread and the ratings for the emerging economies relative to the developed economies are wrong.
Even so, how equipped do you think India is to deal with this economic slowdown compared to 2008 and 9?
Firstly, let me make it clear, I'm not saying India has no problems. I'm saying relatively, it has less problems which are a little more exaggerated than the rest of the world. In terms of handling the slowdown, what is happening, if you see our export dependence, that's only 20% of GDP. So if export slows down by say 10, 15, 20%, it could have a 0.5% impact on GDP. But if our exchange rate, which is a benefit for long-term imports, etc., you could have a positive impact. So would we be affected by the global slowdown? Yes. Is it to have a catastrophic effect? No.
Speaking of global problems, we've had the LIBOR rate fixing scandal that's blown up in the UK. How much of a concern is this for India and Indian banks?
The issue is that LIBOR, the basic system in itself of the fixing is flawed. You do not have that kind of base. We don't price off a particular base here. The Indian banking system is very different and has not in any way participated in the excesses that led to the problem.
Buying